Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, many Canadian families are facing financial hardships right now. Would the current offers of mortgage deferrals be a conscious way of navigating this tough financial time?
Well, I think that's kind of going to be the question as we move forward here. I know the amount of deferrals being cited by the Bank of Canada, the Canadian Bankers Association, is an extremely high number. And, there seems to be a lot of criticism of people. In other words, saying that people aren't able to pay their mortgages. What were they doing having the mortgage in the first place? And my answer to that is that you simply have to wait. Like most things to do with a family home, you simply need to wait. Same as the housing market, for that matter, because time really does reveal the reality of a market, or the reality of this mortgage deferral situation as things move forward. So mortgage deferrals, I would pretty much say there would almost be no one in Canada, any homeowner in Canada, who would not benefit for taking a mortgage deferral if it's offered to them without negatively impacting their credit score. Okay, so if you're offered a mortgage deferral, or you can access one without hurting your credit score, there's almost no situation where you would not financially benefit from that. What I mean to say by that is that what the banks are already doing, they are changing this deferral from being something that you envision having to pay once the lockdown ends to something that you're not going to have to pay to the last few mortgage payments that you ever make on your family home. Many of the banks right now, Jim, have mortgage calculators out there where they do the mortgage deferral calculation. Let me pull up as I'm talking to you here. So let me use the TD Bank. It's called homeready.td.ca. HomeReady is such a con job. But anyways, typical stakeholder involvement in the home ownership market. But let's look at their mortgage payment deferral impact calculator. And they all lay it out here. Well, what they kind of say in a convoluted way is they admit that this really isn't a mortgage deferral. It's basically a re-amortization of your mortgage, which they will re-amortize at the next renewal date. But even the way that they explain that, they're not really explaining what's going on. It says here, at renewal, we will reset your amortization period to match your remaining contractual amortization period. And as a result, this may increase your payments whether or not the interest increases at renewal. In other words, the interest rate that you're going to pay in your mortgage. What they're effectively saying is this: if you delay 4 to 6 months of payments, what we're not going to do is say, hey, cough up the money now. What they say is, we're going to allow you to amortize that over the rest of the term of your mortgage. Or, in other cases, we will simply extend your amortization by another 4 to 6 months, depending on how much you defer. Then they go on here and they give you a calculation. There's a calculator here where you can calculate how much your payment is going to be. So in this case, let's say you have to punch in your numbers, and if you know what numbers to punch in other words, to make the calculator reveal the truth, you see that you really, on per $100,000, you're only going to have about an extra $60 of interest paid upon the maturity date. What you're actually going to have is you're going to have all of your mortgage payments added into the mortgage, which will be deferred for a longer period of time. So if your remaining mortgage, say you just started out, after 5 years you can have a 20-year amortization remaining, they're simply going to allow you to extend that amortization for another 4 months. So your amortization will increase from to 20 years in 4 months. The amount of interest that is payable on that at today's interest rates, you're probably going to be renewing, well, I mean, let's not get into that discussion, but if you were to renew at today's 5-year rate, it can be as low as 1.99%. Okay, so you're really not going to be paying anything on that. Inflation alone is going to wipe out that extra cost that you have, because you're going to be paying your mortgage going forward with dollars that are not worth the same that they're worth today. In other words, if you have $100, if you got to pay $100 for something 25 years from now, it's not the same as paying $100 for it today, because the value of the dollar is going to decrease. How much you can buy for the dollar. If you're wondering what I'm saying here, you should look up a little bit, do a little research on inflation and how it affects your income.
And Ross, one of the things I found most effective, I looked at a Hotel Vancouver menu from the early 1900s. A steak dinner with everything was 25 cents.
There you go.
But the average person made what? $10, $15 a month.
There you go.
Yeah. So you add inflation. So your $30 steak dinner today, 100 years from now will be what? $300. But if you can pay it in today's dollars, it's still $30.
Right.
Yeah.
And if that steak only costs, if the steak costs the same price 25 years from now as it does today, it means you're actually paying less for it. So, that's the reality of inflation. So what I'm saying to people is this: the mortgage deferral argument, debate, criticize, demonization of homeowners for taking it simply doesn't make sense, because inflation alone is going to offset this difference. The only concern is your credit score. You also have to understand that this opportunity is taking place at a time that our economy is evolving. So because we study home ownership and we study families, we study the behavior of families in home ownership, we understand that things always evolve, and we have an evolution taking place right now. You're hearing it in the newspaper. You're hearing about work for home. Okay, so let's say that for some of those families who are deferring their mortgage, one of the two spouses is going to have an opportunity to work at home. They're going to need a home office. Well, you can take the mortgage deferral and use that to renovate your home for the home office. Build a home office. Those payments then become the cost to renovate, tax deductible if your employment is set up so that you can deduct office space in the family home. That's an evolution of the home ownership process for some people. Those people, new stay-at-home homeowners, are going to need to hire accountants, because they don't know how much of their home to write off without risking losing the capital gains exemption on the family home. There's another change to the economy. More accountants for the sake of the argument. Well, those accountants are going to have to work at home. So when we talk about mortgage deferrals, and you hear all the criticizing of people going on, you hear all these false narratives that when this is over, it's going to have a debt cliff that people are going to have to jump over. That's not going to happen, because the banks have already transitioned this from a deferral to a reamortization of your mortgage debt. And that reamortization of your mortgage debt is going to take place probably at, if you structure your mortgage in the right way, you're going to be renewing within the next 3 years, because this next 3-year period will set you up for the next 8. So in other words, the first 3 years plus the following 5 of a standard mortgage renewal. Or if you're really prudent, it may set you up for the next 13 years. In other words, you'll use 3 years to time the mortgage market, and then you'll take out a 10-year term loan to be sure that your costs associated to shelter are firm, non-changing for the next 10 years, a 13-year window. So this is how all of these discussions really need to be framed. They don't need to be framed, Jim, as an insult to people because they didn't have enough money put away. Because I can tell you, Jim, that dealing with thousands and thousands of families over the 25 years that I was a sales rep. People were not irresponsible. Some people got into trouble and they had to deal with it. But en masse, homeowners are not foolish. And this mortgage deferral is probably a great way to create a buffer in your life that was never before available.
In other words, if you don't have anything in your savings account and you still have your job, throw it into the savings account so you have 4 months of money available, because the average Canadian says they're like $200 away from bankruptcy.
So imagine the insanity of that belief, Jim, being perpetuated by mainstream media and the shows and hucksters that are out there in the market. They're saying that a large share of the Canadian families are $200 away from insolvency. Okay, those that are homeowners have an opportunity to create a large and substantial, probably between 3 and 4 months of emergency fund that they didn't have at the start of this pandemic. Okay, so if what people were saying was true, why would you not take advantage of this now? Obviously, it wasn't true because we haven't heard of people like the social media is not filled with families out there saying, "Oh, we're going to go insolvent when this is over." You would have heard of that already. The number of calls going to insolvency offices, the ones that are legislated by the federal government to deal with bankruptcies, you would have heard of a multiplicity, like 300, 400, 500, 100% increase in the number of people getting consulting advice from them. You're not hearing that. You're hearing a small increase, but when you look at it in the actual numbers, the actual percentage of the Canadian public, it's a very, very, very small number. So we know that $200 from going to insolvency was another fictitious number that was out there. Yes, there are always people that are living paycheck to paycheck. There are homeowners who are living mortgage payment to mortgage payment. This is an opportunity for those people to put away an emergency fund because they don't know what their life is going to look like as we finally exit this lockdown, which, let's be honest, Jim, let's be 100% honest. This is not going to end in the next few months. It's not going to end this year. It may not even end next year, because anyone who believes that a mother is going to allow their child to take a vaccine that has not been properly vetted and tested over the standard period of time will not allow their child to be vaccinated. It is not going to happen. This lockdown, this period that we're under right now, where everybody is trying to get out of it, there will be no out until a vaccine has been found, safely tested, to a level that a mother would allow her child to take it. This is not like people in their 80s, my parents. But my parents, if a vaccine came up, they may decide to take that vaccine without waiting the standard period that vaccines are tested on, because each day that they're able to live life with the highest quality that they had pre-lockdown is basically invaluable to them. People in critical situations in life right now, you know, people that are dying for cancer. I mean, we've got two in our family right now. Those people, every single day of their life is invaluable. They may take the vaccine if it allows them to hug their child, if it allows them to see someone they haven't seen for a couple of months. But the vast majority of the population is going to be viewed from the perspective of a mother. And a mother is not going to let her child take a vaccine that is not 100% safe. 95% is not going to cut it. 98% is not going to cut it. It needs to be the same safety level that mumps vaccines, chickenpox vaccine works for. That's what they're going to demand. So we need to realize our economy is not going to move forward the way that they're saying they think it's going to be. A V in a V-shaped economy is going to be predicated on a vaccine that a mother finds is acceptable to put into her child.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, in Canada, what is a real estate short sale and how does it work?
Okay, so actual real estate short sales in Canada are not very common, but there are ways to short the real estate market. So these are two different things. So Ross, what is a real estate short sale? So normally we'd say a short sale would be short Canadian banks. We would say to short real estate investment trusts. We would say to short real estate brokerage franchises. Anything attached to the housing market or the home trading market, you can short those items simply by timing the market, taking the trading cycle, and selling off just before the peak of the market is reached. You can then, of course, on the other side, the flip side, you buy in at the bottom. That is the easiest way to short real estate, but it's not specifically shorting a residential home for the sake of the argument. Now, how do you short a residential home? Well, these opportunities are only available in short periods of time, and really what they're used for is to get out of a situation that before too much damage is done. So sometimes, but very rarely, do consumers feel comfortable enough with the housing market that they go out and they buy their next home before their current home has been put on the market and sold, okay? So over the last 40 years, Jim, maybe in total you're looking at about 19 months in total of those 40 years where the trading cycle has been at a point where an existing owner of a home is willing to go out and buy their next home before putting their current home in the market. Now, this is one of the reasons why all of these comments about inventory and how new sales to listings ratios and months of inventory and, the first signs of inventory, the Canadian housing market today has low inventory levels. This is why these arguments are just not rooted in any scientific knowledge of how a housing market works. Because home owners, the vast majority of time, over 80% of the time, always sell their existing home first and they'll then go out and buy their next home. Okay? They don't go out and buy their next home and then sell their existing home. But that's effectively what a short sale would be. In other words, you understand that your home is going to be worth less money tomorrow. You have that confidence and that belief. So you want to sell your home today because you know the home that you're going to buy later is going to be dropping in value by the time you're ready to buy it. So how would you do that? Well, in the right market, you would list your home. Let's say for the sake of the argument, you would sell your existing home in January with the plan of buying your next home in May or June. So you believe you're going to get top value for your home in January, and you expect that when you go out in May or June, home prices will be falling. You'll be able to buy your next home for less money than you would have to pay for it in January. That is how you would short a short sale in a real estate market goes. It would also be as an investor. You've got an investment property, and you see the trading cycle is moving, and you decide that you want to exit the market at the peak of the trading cycle, but your tenants aren't ready to move out yet. So you sell the property to the next investor at the peak of the market. The next investor buys it with a closing date 6-8 months in the future. Well, you're smart. You understand that 6-8 months in the future, your home is going to be worth less money. And when that investor closes on it, he's going to be closing on a property that is worth less money. You just exited through a typical short sale. Now, these are very complicated. You're working on very few small margins generally, Jim. Less than 5%. Now, again, if it's a $500,000 house, that's $25,000. But it's not really something that people should be looking at exploring. The short sale that they should be looking at was the other one I talked about. You can short a Canadian bank. You can short the economy. How do you short the economy or the TSX? Well, you short that by understanding that the Canadian economy is dominated by household consumption. Household consumption, in turn, is dominated by the wealth effect. The wealth effect is, in turn, dominated or controlled by the trading cycle. If you follow that pattern, then you know when you can short the stock market. You could technically short banks because of the herd mentality in the stock market. I mean, this has really led us to a great conclusion. This portion of the show. Look, folks, these rebounds that you're hearing reported in the stock market are not real. We have seen these happen in the past. We have seen it as far back as the Great Depression. The Great Depression, where there was a 30% increase in the stock market after the first wave of the Great Depression took place. We saw it in 2001. We saw it in 1990. We saw it in 2008. In Canada, we didn't see it as much because because the Bank of Canada acted in the way, and because of our home trading infrastructure is so much different than that in the United States of America. What we're seeing right now in the stock market has been recorded at all other times in the past. You just have to go back and look for them. Now, I'm not a stock market analyst, and I don't pretend to be, but you can talk to your own professional in the stock market and ask them for how the markets have responded in the past. When you're shorting something, you need to be sure that your short call is assured. Now, I would say you can short the real estate market right now, but I also will say that you could short the economy. There's no way that stocks, companies in Canada are worth today, coming out of this, by this lockdown end, by the time by the time a vaccine is found, a vaccine so reliable that a mother will give it to their 3-year-old child. The companies will not be worth what they were worth then. There will be some companies that will actually be worth more because of the evolving nature of the family as a result of this lockdown. And really, when we talk about short selling or shorts of any nature, that's really where any focus would be. So for those who brought forward this question, that's what I would say where you look at. If you want to short real estate, you're really shorting the wealth of a nation, and you have to know where the wealth of the nation is going to impact other investment assets.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, CMHC has suggested home prices could drop as much as 18% in Canada. Realtors are claiming the market is already rebounding with multiple offers for some properties across the nation. How do families know if they're trying to catch a falling knife or knock the ball out of the park if they're buying a home over the next 6 months?
How do they know? Well, I'll tell you on the show today, you're trying to catch a falling knife, folks. if you listen to the two previous segments in there. So what I'm saying here today is a result of about 3 months of study into how all of the aspects of the wealth effect are being changed and will impact our economy. Okay? This is not a flippant comment. These are not guesses. You know, I'm not coming on to the show to give people advice or give an opinion that I can't back up with data. Okay? I can back up everything I say with data. Like I said, we have been studying this since day one. Since the moment the Ontario government announced the shutdown of the Ontario economy, which was 1 week after, by the way, 1 week after I had shut down practicing my youth sports team. Okay, I had shut it down a week prior to. The lockdown happened. Since that moment in time that's taken place, we have been studying the consequences of this lockdown. And we don't know what everybody's talking about when they talk about V and U-shaped recoveries. We don't understand all this conversation about the stock market going back up. We just can't understand it because we can't provide the math to support it. In the two previous sections of this show, we've talked about a vaccine. And you're going to see this going forward, Jim, that this increasingly becomes the conversation that we have. Because, again, we look at everything from the perspective of the family. And in this particular instance, we look at the perspective of the mother with a young child. And whether or not an educated, knowledgeable, and open-minded Canadian mother will allow a vaccine to be given to their child that is virtually untested. And we don't see that happening. So if we don't see that happening, what that means to us is the restaurants are going to remain at half capacity or less. The freedom to go shopping for clothes is not going to happen. You're going to wait in line. You're going to maybe buy something, but you're not going to be able to try it on before you buy it. Cars. People are not going to borrow $40,000 for a new car when they're not sure that they're going to have a job next month. People are not going to buy the economical cars. You know, the cars under $20,000 in Canada, which, you know, there's not a lot of them, but those cars are purchased by families in the low-income jobs, which are being impacted by this right now. So when CMHC says something like home prices could drop as much as 18%, this is what CMHC is actually saying. They're saying that high-priced homes, if you look in their charts, in the reports, they don't use house prices. They say MLS average. They don't say MLS average house price. They don't say MLS average price. They say MLS average. And then in a corresponding paragraph on the opposite side of the page, they mention house prices. Well, if they're measuring the MLS average, the reason why the words MLS average price, MLS average house price, resale price, no longer appears on those charts is because we explained to CMHC that MLS has nothing to do with house prices or resale house prices. So they removed those words from those charts. Yet they're claiming the prices are going to drop in 18%, and on the chart, they're citing an MLS average without using the word price. Now, how can I get the MLS average to drop by 18% in Canada? I can't. There are not enough first-time buyers out there ready to jump into the market that will drop the MLS average by 18%. They don't exist. You will also see in these charts, Jim, that they cite year-end price projection. Year-end price projection. What that means is their price forecasts for this year are virtually impossible. You will also see, Jim, that in these reports, they give this range of price change. This range of up and down. So an upper gauge of what prices could be forecasted and a lower range. Well, if you look at their ranges that they're forecasting, what they're basically doing is they're taking the price the value that houses are at today, the way that they calculate it, and that's the number that's in the middle. Yet they don't tell anyone in these charts that that's what they're doing. I mean, we're looking here in Vancouver, and they've got a price forecast. Or let's go to Toronto. Toronto's the easy one because it's so hilarious that they even cite it. So in the CMHC report, they are quoting the Toronto house price. Now, that's not what they're quoting in the chart. In the chart, they're quoting the Toronto MLS average. Well, the Toronto MLS average has nothing like the Vancouver MLS average, because the geographical penetration of the Toronto Real Estate Board in the cooperative listing service environment in the greater Golden Horseshoe of Southern Ontario is nothing like it is in Vancouver, where you have a real estate board in Vancouver has a clearly defined and limited range of providing services, because the Fraser Valley Real Estate Board across the street won't let them come into their territory. In Toronto, in the city of Oakville, for the sake of the argument, there are 3 local boards that compete for listings in that marketplace: the Toronto Real Estate Board, the Oakville Milton Real Estate Board, and the Realtors Association of Hamilton Burlington all compete for listings in that marketplace. You don't have that in Vancouver. In Calgary, they're cherry picking a stat, which they don't even understand how that real estate board releases their data, as they do in Edmonton. Ottawa, we don't even want to talk about, because there's a multiplicity of, there is an increase in the number of sales that are being counted more than one time. So I'm just getting all this out in the open when we talk about their forecasts. In Toronto, they're saying that in 2019, the average price is going to ended at $819,000, and it's going to end at a forecast range of $825,000 to $870,000, the MLS average in their forecast. Low of $825,000, high of $870,000. Well, guess what it is right now, folks? It's for $843,000, right dead center. They picked a high and a low, basically $20,000 less or more than what today's price is. What that means to us is they have no understanding of how housing markets function and how MLS systems report stats. Because how MLS system reports stats, it means to arrive at the higher price, over the next few months, virtually no homes are going to be sold, and the only homes that sell are homes that are higher priced, which is an impossibility unless you have foreign buyers coming into the country to buy expensive homes. Because normally there are 3 sales that need to take place before that more expensive home sells. On the lower end of the range, what they're trying to say is, for the remainder of this year, first-time buyers are going to jump into the market. Well, if that was true, then the following year, 2021, a whole bunch of expensive homes are going to have to sell, because all of those trade-up buyers are now homeless, because they sold their home at the end of 2020. So into early 2021, they're going to rush out and buy their more expensive home. Yet in 2021, the top forecast is only $840,000, or the exact same price that the average home buyer is spending as of May of 2020. It's all nonsense. It's blatantly clear in this report to anyone who can read, and they can go back and cite all of these things that I've quoted, that CMHC believes a bunch of nonsense itself. It actually says MLS sales in their charts. It actually says, oh, here we go. So on the chart, what they've got, so I might have to correct what I'm saying here, Jim. They have used the word price on the MLS average price. So they haven't said house price, they haven't said resale home price, but they have used the word average price. Well, what they're measuring is buyers. How much is the average buyer going to be spending? And their forecasts simply conclude with that the math doesn't work. What they're forecasting doesn't work. And that is in all of the forecasts that they have out there. So when you're hearing comments about the housing market dropping 18%, Understand, real house prices will have to drop between 40 and 50% in order for the MLS average to drop 18%. That means home buyers will be buying home at a 50% discount when the MLS average reports an 18% drop. That's just how housing math works, folks. We're not here to explain the whole rigmarole to you, but that's how it works. Don't try to catch a falling knife. The best way to deal with a correcting housing market, a contracting housing market, a crashing housing market, is to find out what the definition people are using for those three things, because they're never outlined. And the second thing is to don't catch the falling knife. Let it hit the floor. Stick the pointy part of the blade into the floor, and when it stops, reach down and grab it and take it out. Don't try to catch it, because you're going to lose. It's just let it drop. You're not going to lose anything. The market can't turn around on a dime. Home buyers are not going to run out and start getting the housing market turned up the way that it was. That is a mathematical impossibility. Mathematical impossibility, what I'm saying is the sales volume required to make that happen can't take place in 1 or 2 months. You're going to hear all kinds of stories of multiple offers. Well, why are you hearing about multiple offers? We just discussed it earlier. People are no longer going to go out and buy their next home before their current home is sold. That means you're back to the old way that the trading cycle works. The way that it works over 85% of the time. You're going to have to wait for all of this change to get recorded in the stats. And by the time you hear it recorded in stats accurately, you're going to be 1.5 years away from now. People have to remember, only at the starting of this year, well, actually, you would have started to hear about it about now, the reality of the revisions for B20 from way back in 2018 would start to be recorded in the housing market almost 2 years later. And the 2016 change, this is the first full year that you're going to see it recorded. That's why, all of a sudden, house prices supposedly were going up again. No, it wasn't. It just means that now fewer first-time buyers were buying homes. Don't catch a knife, folks. Let it hit the ground, bend over and pick it up.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.